Okay, look, we might crack on and get started. Folks are still filing in, but we still have the housekeeping and all of that kind of thing to do. So let's get on with it. Okay, so hi folks, and thank you for joining the webinar today. It's great to have you here at the Mythbusters Financial Reporting webinar. For today's webinar, as I've mentioned just before, we've got the wonderful Nat Denniswella, who is the manager for the Financial Assessment Unit, here with us today. And as always, we've got some great support behind the scenes as well. So we've got Joss from our education and engagement team in the background, and we have Chloe and Tennille from our financial assessment unit as well. My name's Harm. I'm the education and events coordinator with the QBCC education and engagement team. Okay, just before we begin as well, I would like to acknowledge the traditional custodians of the land I'm currently speaking to you from, and pay my respects to their elders past, present and emerging. I also acknowledge the traditional custodians of the land on which each of you are living and working, and I extend that respect to Aboriginal and Torres Strait Islander people here today. Okay, on to a little bit of housekeeping. It's always the most interesting part of the webinar, I think, but anyway, it's got some relevant information in there. So the first thing we'll talk about is the survey. So at the end of the webinar, you'll get a survey asking for your feedback. It only takes a couple of minutes to complete the survey, and that survey really helps us to bring you the content that you expect and you value as well. So please take a couple of minutes at the completion of the webinar to fill out that survey. In terms of audio settings, if you're using a mobile device and you can't hear the sound, please check your device settings. So for Android users like Samsung or Google, make sure you press the volume buttons to turn up the volume as normal, but this time adjust the media channel volume. So for some, it might mean pulling down on the slider at the top of the screen, but most of you shouldn't have any issues. But if you can't hear, just have a look at that media volume level on your device. Okay, we are getting towards the end of the housekeeping. I apologise. So for questions, in terms of any questions that you've got to ask, as you can see on the slide on your screen in the highlighted section, you can enter questions at any time during the webinar. Okay, so make sure if you've got any questions, pop those into the question box on your dashboard there. We'll do our very best and we'll endeavour to get those questions answered. Inevitably, with a webinar attendees of this size, we may not be able to get to all of the questions within the session, but rest assured those questions that come through are all recorded, so we have them and we are able to get to them as soon as we're able to. Okay, so I think that's probably enough from me. So Nat, over to you, and we'll get into the good stuff.
Thanks, Harm. Question that's come through already, will this webinar be recorded? And yes, I believe it will be. So thanks to everyone who have joined this afternoon. Hopefully you'll get something out of it. As Harm mentioned, if you have any questions during the webinar, please shoot them into the chat function. If we can't get to all of the answers this afternoon, we will endeavour to provide the information to you at a later date. And the topic today relates to minimum financial requirements and myth busting. I won't be saying the word myth very often throughout the webinar because it tongue-ties me every time. I will try and cover off on some of the issues we've come across though, and hopefully resolve confusion on these issues. We do have 45 minutes set aside for the webinar, but those of you who may know me or have heard me do presentations in the past, you'll know that public speaking is not my forte. So hopefully I'll be able to give you some time back into your day within that 45-minute time frame. So let's kick off, Harm. First myth we're going to bust, or at least try to, is the difference between providing financial information for annual reporting purposes as opposed to providing an MFR report. So annual reporting is just that quick financial health check once a year. And for most licensees, it's their internal management accounts or a 3-page annual reporting form. No accounting standards are required, and an accountant is not required to provide the information. So for annual reporting, we wouldn't expect or require to see things like accruals or depreciation in the financial information because they are accounting concepts. Each year, For annual reporting submissions, the due dates are set at 31 December for mid to large licensees and 31 March for SC1 or SC2 contractors. However, an MFR report is only required in certain circumstances, and they're listed out on the slide that you might see at the moment, but they include a new license application, decreasing your net tangible assets or increasing the maximum revenue, or if the licensee is audited by the Commission. All accounting standards are required that are relevant. They are required to be applied, and the financial statements can't be any older than 4 months in age at the time that the report is signed off by the accountant. So for annual reporting purposes, no MFR report is required to be provided. It is just the internal management accounts for categories 1 to 3, or that 3-page annual reporting form for SC1 or SC2 contractors. Whereas MFR reports are the highest standard for reporting and are only required in those certain circumstances. A common question we receive is whether the financial information submitted can be used for both annual reporting purposes and for MFR reporting. The answer is that if you need to provide an MFR report, just bearing in mind that one of those is only required in those certain circumstances, yes, you can use the financial information for 30 June for both annual reporting and to provide the MFR report if you need to. An MFR report, though, based on financials of 30 June would need to be signed off by the accountant no later than 31 October, which is that 4-month rule. If it's outside of those times, then your 30 June financials would be used for annual reporting, but you'd need to provide more recent financial information to be used in an MFR report. So hopefully that makes a bit more sense. Just a reminder for annual reporting submissions, if you're an accountant and you have lodgements to submit on behalf of your clients, make sure you have been authorised by the licensee to lodge on their behalf. It's also really important to make sure that a licensee's details are up to date, and the light's just gone off here. Sorry about that, folks. So just to recap, make sure that our licensee's details are up to date, particularly email addresses, as we send out reminders before the due date to the email address that we have on record. I think I might need to move a bit more to keep the light active. On the flip side of that, though, the financial information you provide for annual reporting does not affect the maximum revenue amount or the last approved net tangible asset position that has been set for your license. This can only be done by providing an MFR report. So the information that you provide each year does not change the information held on record for the maximum revenue or net tangible assets. As the reporting requirement for annual reporting is less onerous than the information that's used within an MFR report. Queensland construction income. This is actually one of the more common misconceptions that we encounter. A lot of licensees and accountants think that they only need to report their income that is related to construction undertaken in Queensland, which is not actually correct. Licensees must report all of their income, regardless of whether it's carried out in Queensland and regardless of whether it is construction related. The reason for this is that income from other sources or areas can still have a significant effect on a Queensland licensee. Let's say, for example, you own and run a company called Fit Outs and Foils, Pty Ltd, and that's the best name I could come up with at short notice. And that company runs a business, a building business in Queensland specialising in shop fit outs, but it also runs a hairdressing shop in Victoria specialising in foils and hair dyes. Let's say that hairdressing supplies go through the roof in price, coupled with people in Melbourne no longer wanting as many cuts and colours. This could cause the company as a whole to make substantial losses, and that could then place all of its Queensland construction creditors at risk as well. So it doesn't matter if an entity carries out work in Queensland or in other states, or carries out building work as well as owning a hairdressing shop. All income from that one entity must be reported as the actual revenue undertaken. License class exemptions. So if you hold a license in the class of building design or hydraulic services or site classifiers, you are generally exempt from having to provide financial reporting to QBCC. And the reason for that is that the risk to the industry is alleviated by you having to hold professional indemnity insurance. Most professional indemnity insurance policies go for a 12-month period, and they can expire at any time during the year. As I mentioned earlier, most licensees have the annual reporting day of either 31 March or 31 December. If you hold a license in one of the exempt classes and you haven't provided your current PI policy to us after you've renewed it, you'd need to meet the financial requirements like all other licensees, including the annual reporting requirement. So the important message is to email us a copy of the PI insurance as soon as you renew it each year. And if you are a licensee in one of those exempt license classes and you receive reminders about annual reporting, chances are it's because we don't have a current PI policy for you on file any longer. Corporate or company structures. With this one, you need to be aware that the company is a completely separate legal entity to you as an individual. So if you trade through a company structure in the building industry in Queensland, you need to ensure that the company has its own license. The other point to make is that if you hold a contractor's license in your own right, as well as holding a company license, annual reporting information would be required for both you as the individual as well as the company, even if your individual income is nil and all of the trading has been carried out in the company. This is because you can still trade in your own right as an individual, maybe as a sole trader, as well as through the company. However, if you hold a nominee or a nominee supervisor or site supervisor grade, but a nominee supervisor with the company, it is only the company that would need to financially report to us. So Harm, that's covered off all of the common misconceptions that we see, and hopefully we've busted some of those myths for you. We have received quite a few questions through the webinar registration process, and I thought we might cover off on a few of those if we've got time. I think we've got some time.
We do, Nat, and yeah, let's start with those questions first. I guess that's probably a good idea. So I guess let's go with the first question first. First question is, just one moment, please. What assets are disallowed is the first question.
Okay, disallowed assets. The MFR regulation is the piece of legislation or law that governs the financial requirements. QBCC doesn't have a lot of discretion in how that law is applied, and many of the sections contained within that piece of law. What can be accepted and what has to be disallowed is a really good example of that. So assets that are specifically disallowed are things like cryptocurrency, racehorses, furniture used for personal purposes, superannuation benefits if you are not able to access that super yet, so if you're not retired, and all intangible assets. So goodwill, formation expenses, borrowing costs, deferred tax assets are the main ones. Again, sorry, light's gone off again. Sorry, I need to keep moving. Sorry about that, twice in a row, and it'll probably happen a third time, no doubt.
Probably.
Yep. So those that I listed out there, Harm, they're not the full list of assets that are disallowed. They're just a few examples. So if you need more information, probably head to the QBCC website. We do commonly get asked why we don't accept goodwill as an asset. And the simple reason is that we can't. The law, the legislation is very clear on what assets can be included and what can't be included, and we have no discretion to waiver from that. We did receive a question through the pre-registration process about whether office furniture can be used for reporting. The regulation says that furniture used solely or predominantly for personal purposes has to be disallowed. So office furniture is okay to be included. One of the common areas that we see for disallowed assets is the debtor amount. So while accounting standards focus on the collectability of trade debtors for them to be included in calculations, QBCC's requirements actually go further than that and focus on the age of the debtor amount. So for invoices raised that are between 6 months and 1 year, only half of that debtor amount can be included. And for debtor amounts that are invoiced for more than a year ago, the whole invoice amount has to be deducted. So that is the main one under those disallowed assets of what can be included and what has to be deducted.
That's fantastic. Thanks so much. That's some really salient points in there and some great examples as well. Very much appreciated. So let's have a look at question number 2, and just one moment until I grab that. Okay, so this is a good one. So the question is,
Excellent.
are there, they're all good ones, to be honest. So this question is, are there any particular areas QBCC focuses their attention on?
Okay, well, if a licensee's financial position shows some concerns, let's say the current liabilities are more than the current assets, or the net tangible asset position might be in the negative, we assess the risk to the industry, and that includes stakeholders like homeowners, subcontractors, suppliers, employees, and we weigh up whether it is appropriate to take action or not take action. So for licensees in larger categories, if you're turning over 30 mil or higher, the risk is higher because if that company fails, there will undoubtedly be risk to subcontractors, suppliers, homeowners. They will more than likely be affected by that. Licensees in smaller categories, the risk is generally lower because the number and the value of creditors would normally be lower. So if there are other factors at play, such as a money's owed complaint or maybe some defective or incomplete work lodged by homeowners, that may increase the risk for those smaller or mid-range licensees. Also, if the scope of the deficiency, let's say you're in the negative by, I don't know, $500,000, like $500,000, that can become a significant deficiency for that. So we will weigh all of that up and ascertain whether we take action or provide some education to that licensee. So there's not really a hard and fast recipe for what we look at or what we're concerned about.
All right, fantastic. Once again, thank you for the information and some great information there for our attendees. It's pretty much a statement with a question mark, but I'm sure you'll be able to talk to this, Nat. Basically, it's trust structure reporting with a question mark.
Ooh, trust structure reporting. Not really sure whether the person's asking about trust structures through licensing or project trust accounts. We did do a previous webinar, it might have been this time last year, on the subject of trusts.
Yes.
And that recording from that webinar can be found on our website. Oh, there it is again. Sorry, folks. Maybe I'll just leave it off. So I won't go through all of the detail about the content within that webinar this time, but essentially QBCC doesn't license trusts, probably not likely ever to license trusts. And the reason for that is the trust isn't the legal entity. It can't be sued, and predominantly trusts are set up to protect assets. That's usually why a trust would be set up. We license the trustee company, the PTY Ltd, and that entity needs to hold sufficient assets in its own right, either in its own right or through a deed assured from that director.
Right.
For annual reporting purposes, though, it's the trust's financials that would be submitted to us because the trust is the trading entity. As I said, I won't go into too much detail about trust structures because we had already done that webinar. If it's information about project trusts, though, that's a totally separate topic that QBCC governs or is involved with. There has been some webinars recently on that topic, and I believe that they are recorded and would be on the website. And I believe there is another webinar coming up for project trust accounts on the 6th of December. So again, if you're if you're chasing information in relation to project trust accounts, maybe head to QBC's website. There might be some information that can steer you in the right direction.
Absolutely. Once again, great information there. I'd probably add to that just very briefly as well that yes, that would be on the QBCC website, but also if you have the inclination, you can also check those videos and that information out on the QBCC's YouTube channel as well, which is where most of those videos also sit. So
just trying to move around a little bit, Harm, so the light doesn't go off again.
No problem at all, Nat. No problem at all. Okay, so let's head into the next question. And this is another one which is sort of basically a statement with a question mark, so it's quite general in its nature.
Right.
But I'll hit you with this one, Nat. So it's general purpose financial reports question mark.
Right. This one we do know
yes.
about. Very common issue at the moment. So essentially, The Australian Accounting Standards Board revised the reporting framework a little while ago, about 2 years ago actually, and removed the ability for entities to use special purpose financial statements, meaning that general purpose financial statements are now required. Because QBCC's legislation states that when providing signed financial statements, these must be prepared in accordance with accounting standards. That means we can no longer accept special purpose accounts. It wasn't a change that was driven or implemented by QBCC, it was done by the Accounting Board, so we have no real control over the effects of that. For annual reporting purposes, there shouldn't be a real effect on most licensees because they're able to still provide internal management accounts, and that information doesn't need to have accounting standards applied to it. If you're in category 4 to 7 though, that larger bracket, they would need to be general purpose for annual reporting if it's for a reporting date after 30 June 2022.
Right.
If you're preparing or lodging an MFR report in the near future, those would need to be accompanied by by signed financial statements, and those must now be prepared on general purpose accounts. They can be reduced or simplified disclosures. If you're an accountant or a licensee and you need further information or clarification regarding the preparation of general purpose financial reports, we'd recommend that you seek some guidance from your professional accounting body. That would be the best bet.
Fantastic, thanks Nat. Okay, so we'll punch on through to the next question here. And hopefully your light stays on for this one, Nat.
I'll keep moving.
Next question we've got is, are the financial statements provided to QBCC required to be audited?
No. No requirement for financial statements either through annual reporting or an MFR report. They don't need to be audited. For the higher categories, they can be prepared under either an audit or a review engagement, and for the lower categories, they can be prepared on an audit, review, or compilation engagement. So as long as they've got all of the relevant accounting standards applied, and then the MFR requirements over the top of that.
Fantastic, thank you so much. Okay, so if you give me one moment as well, I'll get on to the next question that we've got here.
Coming through, which is good.
There is a few coming through. I'm not too sure whether you can see that question panel, but there are a few coming through, as well as the ones that we've got here as well. So our next question, can MFR reports be submitted via the My QBCC portal?
No, unfortunately not right now. Okay. It is definitely something that is being worked on for the future, but unfortunately at the moment the online portal is only set up for the lodgements of annual reporting submissions. So to lodge an MFR report, you'd need to either lodge it in person to a QBCC office, or we do have an email address that they can be provided to, which is featured on the MFR report. We have made quite a few changes recently, very recently, to the MFR report, and it now features this beautiful U-Butte stop-go checklist at the front, which should hopefully make it easier to understand some of the requirements. And we've also, even more recently, uploaded a new deed of covenant and a assurance document, which also has the stop-go checklist at the front, again, to try and make that a little bit easier to follow when you complete it. But no,
fantastic.
Portal unfortunately only for annual reporting at this stage.
Great, thank you for that. And yes, I have seen the stop-go checklist, and it does make things much clearer in terms of what logic to follow. So
excellent, good to hear.
Let's see, next question. Okay, so next question. What are some of the common mistakes seen by QBCC when assessing MFR reports? I feel like this is going to be a good one.
Actually, this is a great question. We do actually see quite a few common issues occurring. Common ones would be providing outdated financial information for an MFR report, so older than 4 months old at the time that it's signed off. Another one would be the inclusion of intangible assets or disallowed assets in the calculations, particularly borrowing costs or deferred tax assets. They're usually the biggest ones that we would see. We also still see a few amended financial statements. So where QBCC might raise a concern, maybe on deferred tax assets being included, we would then receive a second set of financial statements, sometimes a third set, sometimes a fourth set. And that leads us to issues of concern about reliability, because they are meant to be true and correct at the time that they're sent to us. So if we receive a number of different statements for the same date showing different figures, it does lead to issues of reliability for us. Classification of or the inclusion of related entity asset loans is another big one. So the asset loan, let's say a director owes a loan back to a company. The asset loan doesn't have to be included in calculations, but if it is, that related entity, let's say it's the director, needs to hold net tangible assets in their own right and have a current ratio of 1:1. And that would be evidenced by way of a balance sheet being provided for the same reporting date as the financial statements provided for the licensee. On the other side of the equation, though, for related entity liability loans, so the company owes the director money, that can't be deducted under any circumstances. They have to be included in calculations or liabilities. The other main common one that we would see would be the failure to properly record the split between current liabilities and non-current liabilities in the financial statements. So it's not a QBCC requirement as such. It's a requirement under the relevant accounting standard, being AASB 101. If, let's say, for example, a licensee has a hire purchase liability, proper provision needs to be recorded for those payments that are due on that purchase for the next 12 months. But often we only see the full amount recorded as a non-current liability. So that'd probably be the main ones that we would see coming through.
Great, thank you so much. Okay, so let's see. Next question we've got is around the 4-month rule on age of financial statements. So the question is, why is there a 4-month rule on the age of financial statements?
I have mentioned that a fair bit throughout this webinar, so it's good to give some clarification on that. So thanks to whoever lodged that question. For an MFR report, the financial statements can't be any older than 4 months old at the time the qualified accountant signs the report. So for financials based on 30 June information, the accountant needs to sign it off by 31 October, or for financials as at 31 October, they can't be signed off any later than 28th of February, if I got my calculations correct. That 4-month rule is set by legislation. So QBCC doesn't have discretion to accept reports outside of that date.
Right.
The intention behind that is to receive financial information that gives us a fairly current period of that licensee to review, at the same time as allowing the accountant enough time to prepare those financials. Although just using that point though, another reminder that an MFR report, they don't have to be provided for annual reporting submissions. So for annual reporting submissions, the financial information is based on the most recent reporting year. That's usually 30 June for most licensees. They have the financial year ending 30 June, and they're provided to us by the end of December each year. So the due date for annual reporting being 31 December, we would accept financial information for 30 June for those purposes.
Great, thanks, Nat. Right. Okay, next question. Sorry, I'm just searching here. The next question we've got is, okay, so it is, I don't understand the difference between a license category and the maximum revenue amount.
Oh, that's a doozy. Okay. I've also mentioned license categories and maximum revenue amounts a fair bit in this webinar, and it can get confusing between the two. To work out your maximum revenue amount, that's how much turnover you can do in a year based off your net tangible assets. And this is usually done initially when you first apply for the license by providing the MFR report with that financial information. So your net tangible assets determines the maximum revenue amount, but we don't release your maximum revenue amount to the public or to anyone without your consent. That's fairly private information between a licensee and the QBCC. It does contain some sensitive financial information of what your net tangible assets would have been. So your maximum revenue amount, though, that puts you into a license category. And the reason that we have license categories is because there are different requirements that differentiate between those brackets. So if you're a licensee within the categories 4 to 7, you'd have a maximum revenue of 30 mil or over. The requirements for those financial reporting, they're a bit more complex or a bit more detailed for those licensees. If you're a licensee within categories 1 to 3, your maximum revenue would be between 800,000 and 30 million. You'd have different reporting requirements to the larger licensees that we see. On the public register for your license, it's the license category that would be displayed, not the actual maximum revenue that's set for your license. So for example, if you're in category 2, let's say, and you've got the maximum revenue of 7 million, your license category is between 3 million and 12 million. It doesn't mean that you can do up to 12 million. You can only do up to what your maximum revenue is. It's just a range that you sit within in that license category.
Right, gotcha. Perfectly clear. Thank you for that. Some of it for me, more so for the attendees, I would imagine. Okay, so here's a question. What does the deed do? I'm sure that makes sense to you, Nat.
I did actually see this question in the pre-registration process,
yes.
and it is one we receive a fair bit as well. When do I need a deed, or why do I need a deed? So a deed of covenant and assurance is used when a licensee doesn't have enough net tangible assets in their own right, and they need to have more net tangible assets to cover the turnover they do or are wanting to do. So the licensee, to use a deed, the licensee must have net tangible assets of at least 0, so they can't be in the negative, and their current ratio must also be 1 to 1. The deed is usually provided to a company licensee by a director, where essentially the director promises some of their own personal assets to increase the company's net tangible asset position. So to use an example of that, let's say a company has net tangible assets of $1,000, but it needs net tangible assets of $50,000 to cover the turnover that it wants to do. The director themselves have net tangible assets of, let's say they own a house of 500,000 and they've got a mortgage of 200,000. That gives them 300,000 of their own assets that they could assure to the company. So they'd be able to assure back to the company that extra $49,000 through a deed that the company needs to make up the difference to the 50,000 that it needs. And a catch to that is, unfortunately, at the moment, the way the legislation is drafted, SC1 and SC2 contractors can't rely on a deed. They need to bump up to a category 1, and that's just the way the law is written at the moment. Just a note that the deed of covenant and assurance doesn't factor or can't be used in the current ratio, so it doesn't go towards the company's current assets. It is only used to increase the net tangible asset position. Also, for annual reporting purposes, you don't need to factor in the deed amount because the annual reporting information is only for the trading entity. So using the example, the company has the net tangible assets of $1,000, that's all you'd need to provide for annual reporting purposes. We know that there's a deed held on file for that company. If you do need more information for that, probably again best to shoot to our website, and there's a fair bit of information in relation to the deeds of covenant on there.
Perfect. Thank you so much, Nat. And I guess now's probably a good time just to recognise and thank the questions that are coming through. Thank you to Karen and Blake and Russell, and there's a few other people as well. Michelle has sent through a few questions, and it looks like we're getting to those. So thanks very much to Chloe and Tanil who are in the background.
Good to hear.
Beetling away and getting it all done. So thanks very much for that. Look, I think we've got, there's another question here for you, Nat, so I hope you're ready.
Fire
away, okay. So the question is, why do SC1 and SC2 contractors need to complete annual financial reporting?
We do get asked that. The answer is that it is part of the requirements for all licensees from SC1 up to Category 7 who hold contractors' licenses. They need to comply with that financial reporting requirement. It also assists the licensee, though, to know the business that they're in. it's good to know if you've got any financial issues that you may need to be aware on. It can provide that immediate attention to those financial issues, as well as being able to identify for you whether you need to move into a higher category if your company or if your licensee is trading at a higher level to the category that they're currently in.
Gotcha. Thank you. Thank you. Let's see. Oh, hang on. I've skipped past. I don't want to skip past any questions. One moment. Let's see. No, we've got YDSC1. We've got that one. We've answered that question. I think we've got a question here. Let's see. If a licensee exceeds their turnover threshold, when do they need to apply for an increase?
Another great question. The legislation states that if a licensee exceeds the actual revenue, so let's say the actual revenue exceeds the maximum revenue that has been set by more than 10%, the licensee must, before the actual revenue exceeds that maximum revenue, apply to increase the maximum revenue. There's no actual penalty provision attached to that breach, but you could be audited by QBCC if the breach isn't resolved, and particularly if it's a fairly large breach as well. If you lodge an MFR report to increase the maximum revenue, you'd be able to continue trading as normal whilst QBCC assesses and actions that maximum revenue upgrade, because the law requires the licensee to notify QBCC of exceeding their revenue. So by lodging the MFR report, you've actually been deemed to comply with that obligation. For annual reporting purposes, if an annual reporting lodgement is due at a time when the MFR report has been lodged but not yet accepted by QBCC, the category that is being reported for the existing licensee, that's the financial report that you would submit. So if you're currently in SC2 category and you have the 31 March reporting date, you'd still lodge that by 31 March until such time as you are upgraded to a Category 1 licensee.
Fantastic. Thank you so much. Okay. So we've probably got, we've got this question. Let's see. Okay, Nat. So the question is, how do you apply for, or can you apply for, an extension of time to lodge annual figures if you cannot get them done by the 31st December deadline?
Unfortunately, no. There's no provision within the legislation that allows for an extension of time on the annual reporting requirements. For the bulk of licensees, which are due to report by 31 December, the requirement is for internal management accounts, so they can come straight off whatever internal accounting software you might use, so whether that's QuickBooks or Xero. And just also to note that 2 reminders via email are sent out prior to the due date, and then 2 reminders are sent out shortly after the due date.
Right.
If you haven't lodged after those 2 reminders after the due date, it's likely that QBCC would then start into regulatory action for non-lodgement. So it is fairly important that you do lodge within a timely manner.
Great, thanks, Nat. That's fantastic information. Okay, so it looks like, and I'm not too sure what you can see on your side there, Nat, but it looks like we've got all the questions from what we've got here, and also all the questions that have come through during the webinar as well, which is great. So I guess this is where we could probably draw the webinar to a close and give some folks a couple of minutes of their day back. As I said, we've got all those questions. It looks like we've got all those questions answered. In saying that, rest assured those questions are recorded. And once again, if you do have any other questions that you'd like to put through, please do that through either contact us or you can put that through the contact center as well. So we might bring the webinar to a close. What do you think, Nat? Was
it meant to go to 4:45? Look, we've done pretty good, pretty close
we
to
have.
that.
We absolutely have. So there's still a couple of minutes left. As I said, we can sort of keep it open for the next couple of minutes just to see if any more questions come on through. So folks, if you have any questions, please get them on through. As we said, though, this isn't sort of an ultimatum. Obviously, there are other ways that you can get questions through to us, for example, through Contact Us or through the Contact Centre. I believe there is an email address that'll pop up at the end of the webinar as well that you can send questions through to.
We can definitely still take them offline as well, Harm, that if
Yep.
You do think of a question and someone hasn't asked it already or it hasn't been addressed already, we can definitely reach out to you directly through that registration process. I think we do have people's email addresses,
Yes.
so we can come back to you directly with the response to any particular questions.
Absolutely, absolutely. Okay, we might wait for maybe one more minute as those questions come through. Last chance. And just while we're waiting for those, I guess it's probably a good opportunity to send out thanks once again to, well, I'd say first of all to Nat, so thank you very much for your time and effort and expertise, especially for this webinar and for our attendees. Big thanks also to Chloe and Tennille, who are, and Joss as well, who are the unsung heroes in the background at the moment, answering all those questions, getting all the background things done. Also, very importantly, thanks very much to Bill Duval, who was instrumental in initiating the webinar as well and making it happen. We really appreciate everyone's time, effort, and expertise. Also, thanks very much to you, the folks that have attended, and everyone that's submitted questions. Thank you so much for your participation and feedback. As we said, don't forget the survey. It is very, very quick, probably about 2 or 3 minutes. And it, like I said, we said before, it does help us build better webinars, so please help us out. That'd be fantastic. And look, I guess...
Just be kind on the presenters.
That's right. Please be kind to the presenters. That'd be great if you could do that.
Just remember, public speaking is not the forte. Remember.
You've done tremendously, Nat. Absolutely fantastic. And I guess, look, this probably brings us to the end of today's event. And on behalf of the Queensland Building and Construction Commission, I'd like to thank you all once again for taking time out of your busy day. And folks, thanks and bye for now.